Welcome to Alexander Forbes Investments Weekly Economic Forecast, presented to you by myself, Isaiah Mhlanga, the Executive Chief Economist. To start with, I'm going to touch on the global equity markets decline that we have seen over the past week, led by the S&P 500. Of course, this comes at the back of technology stocks that disappointed in terms of their earnings. This started a risk-off trade which saw significant bond outflows and equity outflows from emerging markets, including that of South Africa. We have seen also currencies from emerging markets falling quite significantly, extending the falls that we have seen since the beginning of the year. This is quite important because it makes us start to question whether this is the beginning of a bear market that we have been thinking about for most of this year. Yes, we expected a bear market to come because US equity markets are overvalued and the rising interest rates potentially are going to spark that beginning of the bear market. But of course, we only expected this to start 6 months from now. It is difficult to time markets. Therefore, we are not going to try and predict this is it. But if we look at the conditions, US equity markets are overvalued, interest rates are rising, we have significant risks that are coming from trade tensions between the US and China, which means stars are all almost aligned for a potential bear market, which means you are likely to see many fund managers start to position defensively in terms of their portfolio allocation to protect investor funds or investor portfolios. Coming back at home, we had the medium-term budget policy statement that was tabled by Finance Minister Tito Mboweni on Wednesday last week. In terms of the numbers that were presented, it disappointed. Firstly, economic growth was revised downwards to 0.7% from a previous estimate of 1.5% at the beginning of the year. And that had implications for lower tax revenue collections. For this fiscal year, we have a 27.4 billion rand revenue under collection. But if you look over the medium-term expenditure framework, which is the next 3 years, we have an 85 billion rand revenue under collections, which implies that governments need to borrow more in order to finance a larger deficit of 4.3% if you look at the main budget. But that deficit does not decline to the same extent as it was projected at the beginning of the year. It only goes to 4.2% at the last fiscal year, which means our debt to GDP ratio no longer stabilizes at 58% of GDP, but it stabilizes at 60% of GDP. Even that, the growth forecast for the outer years are a little bit more optimistic than what we have projected previously. Overall, from the MTBPS, we expected markets to sell off, and indeed they did sell off because it disappointed. But more concerning is the potential credit rating implications from Moody's, which still has South Africa's credit rating at Baa3 with a stable outlook, which is the lowest investment grade that we have. S&P and Fitch already have us on sub-investment grade, so we are not so much concerned about those. We are concerned about Moody's because if they downgrade us, we are going to have at least 100 billion rand in portfolio outflows. The rand is going to sell off. Bond equity markets also going to spike in terms of their yields, which has ramifications for South Africa's potential borrowing requirement going forward. Lastly, the investment conference, which is for the first time that we have seen since democracy, it has managed to attract 290 billion rand in potential investments, this time around from local private sector companies, which is a departure from the investment strike that we have seen over the last decade. It seems President Ramaphosa and his team has managed to woo local investors to come and invest domestically, which is going to be quite positive for jobs, quite positive for reducing the unemployment rate that remains very high at 27%, which is one of the highest in the world. This is also important because the focus on investment in infrastructure offers us an opportunity to invest in what we call private markets that are not correlated with traditional asset classes like equities, which then means if equity markets fall as they have done over the past week or in the year to date, private markets returns are going to cushion the drawdowns in portfolios, offering the opportunity to start from a higher base, which speaks to our living investing, risk-focused, forward-looking investment philosophy that we have here at Alexander Forbes Investments. That's it from us this week. Signing off. This is Isaiah Mhlanga from Alexander Forbes Investments. Thank you.